Hi, Else here, and in this series of videos, we're going to talk about financial statement analysis. You know that the goal of accounting is to produce financial statements that can be useful for decision making. Financial statements are used to both understand and evaluate, which means assess or judge, the results of business activities. For instance, the managers of a business use financial statements to review past performance and make decisions about the future. Creditors, such as banks, use the financial statements to assess a business to make decisions with regards to loans. Shareholders, who are really the owners of any business, assess the financial statements to make decisions about future investments. Every single stakeholder who has to make resource allocation decisions, that's decisions about, you guessed it, money, use the financial statements to make informed decisions, but they can only do that if they analyze the financial statements in a systematic way. That means organized or orderly. Generally, in accounting courses, you're taught specific financial statement accounts in isolation. For instance, you might learn about accounts receivable and the allowance for doubtful accounts, but it's separate from the business decisions that might be impacted by those balances. The problem with that is you can only understand and evaluate a business when you look at the financial statements as a whole. That's why in this series of videos, I'm going to introduce you to vertical and horizontal analysis, as well as some important financial statement ratios. By combining your understanding of the different accounts with tools to analyze financial statements as a whole, you'll gain a deeper understanding of a business's financial position and their performance. This allows you to assess the past and make decisions about the future. So, what's needed to perform an analysis of the financial statements? Well, first, you need comparative financial statements for the business. Note that the word comparative means that the business is providing both the current year's statements as well as prior year's statements, sometimes as many as 4 prior years. This will allow stakeholders to compare the financial position and performance over time. So, what are the two main types of analysis you'll complete? One, you can perform horizontal analysis. Horizontal analysis calculates the trend between one year and the next. It allows you to see the important changes that have occurred over time. For instance, comparing inventory balances over time allows a business to see if its inventory levels are increasing, decreasing, or similar to prior years. Knowing that, however, isn't enough. You also need to compare that information to the change in sales over time. This will allow you to determine if inventory levels are appropriate given the change in sales over time. If inventory levels are increasing from one year to the next, but sales have not changed, or worse, they've actually declined, it might indicate that the business is not controlling their inventory purchases. Recall from our coverage of inventory that rising inventory levels have a cost in that the cash invested in inventory won't be available for other things, such as paying down debt. In addition, rising inventory levels may be problematic because technology changes over time, and that may make it difficult to sell existing old inventory. You can also perform vertical analysis. Vertical analysis shows the relationship between different items on the same financial statements. For instance, you might calculate current assets as a percentage of total assets on the balance sheet. This shows the contribution that current assets make to the overall asset position of the business. If you compare this percentage between 2 years, you can then see if the business has increased or decreased their current asset position. Vertical analysis is also called trend analysis because you are comparing different years to see if there is a trend, increasing or decreasing. Vertical analysis is the only analysis that can be performed between two different businesses within the same industry. Even if the businesses are different sizes, the use of percentages will allow you to compare them because it removes the factor of size. When vertical analysis is used to compare two businesses, it's called common size analysis. Often students find horizontal analysis easier to understand. So, in the next video, I'll start by introducing horizontal analysis.